Alright, what's up everybody? Baller Trader back again with episode 3 of Professional Bitcoin Trading Series. Gonna see how this goes. I'm gonna run through it. The four major market profiles is a very profound concept in the Bitcoin market to me. Originally taught by ICT, not one of his most talked about concepts, but what I found is that it's very profound in the Bitcoin market, and I just want to show that, and let's get into it. I also call this in Bitcoin, since it is so repetitive and it is just so apparent and so profound in the Bitcoin market, I call it the price rebalancing blueprint, and we'll explain why I kind of view it like that. But for now, we're going to get right into it. And why we're going to ask, why does the four market profiles stand out so much in the Bitcoin market? And what I think is Bitcoin is simply just a very basic market. There is fewer market participants, and this amplifies price action concepts. Really, the only relationship in the Bitcoin market is between market makers and speculators, as far as I'm concerned. And there's not really any economic data that can impact this market. Interest rates, no one's watching CNN looking at what Draghi's saying about euro interest rates. No one's looking at supply and demand of any kind of commodity and asking what's going to happen to Bitcoin because of this. So the fundamental drivers in Bitcoin are rather limited, if there's anything at all. And there's also a lack of price insensitive market participants. What I mean by that is in all markets, there are going to be hedgers, and there's just going to be people that need to do business and without the thought of financial gain through their interaction in the market as a motivating factor. To simplify that, farmers, if they see a fair price of corn and they have corn that they haven't harvested yet, they're going to sell at that price just because in doing so, they can ensure themselves a profitable transaction, which allows them to continue their business. Consumers, on the other hand, are going to buy corn at any fair price because they're in the business of manufacturing a good from the raw material that they're buying. So let's say Kellogg's, they're going to buy some corn at a fair price. They're going to make it into corn flakes and they're going to sell it. And their profit is not realized by interacting with the market. Their profit is realized by producing a good for cheaper than they can sell it for, and then capturing the difference in the form of profit. Forex is the same. There's going to be people that need to make payroll. There's going to be corporations that have foreign employees, and they're going to owe them millions of dollars when payroll comes around. And they're just going to go into the market so that they can continue to pay their employees, so that they continue to run a business. There's also going to be speculators that want to engage in a foreign market, and so they'll buy that foreign currency so that they can invest in the foreign currency's assets without really being too sensitive with what the price of the currency required is, because they're looking to make a profit on their other investments. And really, Bitcoin lacks all that. Really just the market maker and speculators, and really the only reason to be trading this market is because you think it's going to go up or down, and that really leaves a market environment void of really too much of anything other than the price rebalancing blueprint. And I think that's why these price action concepts really stand out, why they're so profound in Bitcoin. The framework of all markets is going to be accumulation, manipulation, and then distribution. Inner Circle Trader has talked about this, and I find it to be very true as well. And I think that the four market profiles really capture this, basically this motto or this theme, this central driving force of the market of accumulation, manipulation, distribution. The accumulation and distribution, basically Bitcoin is going to be accumulated in the flat markets. It's going to be distributed in flat markets. And once everything has been accumulated or distributed, there's going to be manipulation to inject volatility into the market so that the smart money can then offload their position and the cycle will repeat. And that's basically what the four market profiles are. So what are the four market profiles? Consolidation, then a reversal, then a retracement, and then a consolidation. And then it breaks out into a trend, reversal, retracement, consolidation, to infinity. So we're going to talk about consolidation. And basically, when price is consolidating, it is either being accumulated or distributed by smart money. And so this is the accumulation or distribution phase of the market. What this means is that when you see a consolidation, you know that the manipulation is coming. You know that deep pockets are positioning themselves. And consolidation is basically the ground zero for a price move to begin. And then you just have to determine what direction it's going in and position yourself that way. There's some universal price action behaviors that are expansion and contraction trending to ranging markets. These are two kind of cycles that repeat to infinity as well. The markets are going to expand, and then they're going to contract, and then they're going to expand, and then they're going to contract, they're going to trend, they're going to range, they're going to trend, they're going to range. And so when you see a contraction in the market, you know that expansion is coming. When you see a trend in the market, you know that it's bound to be ranging at some point. And this is basically the foundation of the four market profiles and why I like to view it as a price rebalancing blueprint. But I guess we'll get into that later. And like I said, consolidation is absolutely the prime time to enter into a market. And we will kind of illustrate that why. Basically, here's our consolidation. This is not the best consolidation example, but you see trend, reversal, retracement, consolidation. What we see here is consolidation. The range is very narrow. And so if we are operating as if we are in a consolidation, then we can, if we are bullish, we can buy on a down move. Buying on a down move basically gets us a very tight stop loss, as the whole range is only like $10-15. And if we buy into that down move, then we're getting closer to these lows. And part of the fundamental behaviors of a consolidation is that lows are not going to get taken out. So you can comfortably buy a retracement and you can be safe with a stop under the low. And since you're buying into a down move, your stop and your entry are going to be very close together. It allows you to reduce your risk and make a very low risk trade. And there's the trend. So now we'll go, that's the consolidation. We'll go back to the presentation. Come on, Google. Damn. So then you get into the trend. You've got a very obvious and fluid movement. There's not really going to be stop raids, and price will reach for areas of liquidity to allow for the distribution / accumulation. So that's some inner circle trader stuff right there. But so when we are in a trending market, this is basically a pretty big trend. And what we notice is that when we're in a trend, we don't really see stop raids. So when we're operating in a trend, we're just going to look to, this is a downtrend, so we're just going to look to sell retracements. And we see, here's a retracement, no stop raid. We see lows taken out. then we see a retracement, no stop rate. We see lows taken out here. We see a retracement, no stop rate, and then we see lows taken out. We see a retracement, no stop rate obviously, and then we see lows taken out. And that is basically the formula you want to follow. When you see a trending market, you just want to throw up some fibs or just find a support level that you like and you know, buy retracements, 62 to 79%. There's a perfect tag at the sweet spot. But really, fibs aren't too important. They're just a good tool to help you visualize the retracement. But really, you can see this pocket of liquidity, price moves up to here. You can see this pocket of liquidity here, price is reaching up towards that. And now it's getting really heavy, and it just crapped the bed right there. So that is basically the trending market. The reversal market is pretty much like a trend, except the opposite direction. And the key to a reversal is that it forms with a distinct and powerful reaction at a key level, always. So what we mean by that is I like to use volume, and because a reversal is basically, if we're trending, and let's say the market is all about accumulation, manipulation, and distribution. Well, if smart money has accumulated shorts up here, they are going to look to distribute those short positions at the bottom. And the only people that can create the highest amount of volume and like the most volatile environments is when heavy money is being thrown around. So you can see that on this day, price went from 173 to 220, which is almost 50 bucks. 50 bucks on 173. It's almost like 30% in a day. And no one can create that type of movement unless they got serious positions that they're throwing around, serious pairing of orders, and yeah, that's a clear sign that the market is going to reverse. Just like here, this heavy volume right here, clear sign of a reversal. And I mean, I guess this is pretty basic stuff, but really, it's very distinct. And you see here as well, the heaviest volume. And I forgot to mention another thing is that you want to see market structure break. So I gotta move down to illustrate this point, but basically what we see is, market structure is still intact, and that's what we like to see in a trend. We like to see like the major lows staying unbroken, and that's what we're seeing all throughout here. And this low still cool, but what happens is market structure is going to break here on massive volume, massive selling, and it's a clear indication of profit taking and market structure. A low in the market was taken out, and so it looks like distribution right here, and that is going to signify a reversal. And that's the only thing I have to say about reversals. You just got to look for that big volume and break in market structure. Yeah. So two key things. You want to see high volume, and you want to see a break in market structure. And that's basically the surest thing in the form of seeing a reversal. Retracement is kind of boring. What do I say about retracements? I mean, I'm pretty sure that a retracement is just a retracement, you know what I mean? Yeah, I mean, it just sets up for the consolidation. Boom. And then this is the fractal pattern. So this is what I want to talk about, the price rebalancing blueprint. Basically, we're in a consolidative phase. We expand, and then this is a reversal, but we're contracting, right? This leg is more powerful than this leg, and this leg is more powerful than this leg, and this is ultimately the ultimate contraction. So the entire price rebalancing is exactly what it is. It's a price rebalancing blueprint where we have a price up here, then we have, boom, this entire leg of volatility of trend. Now, the reversal leg is going to be defined by a key high in the trend and the low, right? So it's going to be a weaker leg of price action than this. So it's basically everything's contracting, and it's kind of fractal in that the whole thing started with a contraction here, which led to an expansion. But even this leg here, if we're defining the move to start here, and this is the key low, so this is where we're framing the market. This leg is going to, 90% of the time, it's going to work within these boundaries. And 90% of the time, it's not even going to reach where the original contraction of the trend started. And even building on that, now once we see the reversal, we see the high volume, and we see the break in market structure, and we think it's a reversal, then we're planning on a retrace. But what is a retrace? It's just, it's going to work from this high, from the reversal phase now, to this low, and it's going to be an even weaker leg than the reversal. And then ultimately, the retracement is just going to settle into a consolidation, which is going to be the most constricted, or the least expansive area of price action since the previous cycle began. So we're going from cycle 1, consolidation here, to consolidation here. This is another beginning of a cycle, and prices really just moved from here. It went down, it went up, it went down, and then this whole process is just price rebalancing to settle here in this consolidation. And really, I kind of broke this down a little too far. What we could do is even call this whole thing a trend, or I mean, we could even call this whole thing the reversal, and we could call this the retracement, and then we could call this, like this whole thing, like a consolidation, which would then break out into a trend. So really, we could call this the trend, and then this entire leg we could call a reversal, and then we could call this the retracement, and then we could call this entire thing, just to broaden up the I wanted to give like a more compact version, but now we can really see a trend, reversal, retracement, consolidation into another trend. And we see that with each successive leg, price is getting less volatile and less volatile. And really, the only thing that's happening here is that price started here, and then it dealt, basically price dealt here, up, down, into a rebalancing phase, and then now it's dealing here. So basically, price is just going from here to here, right? But then there's a game you got to play. There's all this volatility that happens, the trend, the reversal, the retracement, and then rebalancing here to what? Form another area of accumulation or distribution, which is going to give rise to another expansive trend, right? So the market makers, I think they're probably just looking at it like build positions here, right? And then their next play is going to be when price rebalances here. Obviously, they're going to be trading this as well, but really, it just drives home the point that consolidation is so important, because that's where everything's going down. Everything starts with the consolidation, then it's going to, because the consolidation is going to be the most compact form of price action, which is going to give birth to the most expansive, right? Because that's just the cycle. It's going to expand and contract. So once it's at its most contracted, then that gives birth to the most expansion. But then the most expansion is going to slowly compact, slowly compact until it rebalances to where it was always destined to go. I think that's how it goes. And just to wrap it up, I want to show this thing from 9 months ago. It's not really a brag or anything because it was wrong in some ways, but I just want to show that I'm not making videos like pulling this stuff out of my ass. Like I'm making these videos because I really believe in this shit, and I just want to, illustrate that my analysis is really based on this shit. If you see, so what's going on here is, I guess this is to illustrate how you can use the market maker profiles, or the market profiles, to forecast, because that's what any tool needs to do. It's cool to see it in the chart in hindsight, but how can you use it to forecast some price movement? Well, here you see this is what we talked about, 177 to 227. So like $50, right? We talked about 30% in one day on a huge volume. That's the big candle that breaks market structure, is probably a sign of a reversal, right? And so I'm just using my understanding of the market profiles to say, this is probably a reversal, and a reversal is probably going to work this range in a compacted manner, right? The trend is going to be the most powerful leg, and we're probably just going to retrace up into the trend at some point. And what happens? We do retrace up into the trend. Not very much, but I mean, from 200, it's not, you can't complain about it. And so this is what we were looking at earlier. We're going to say this is a reversal, retracement. We're going to say the consolidation into a new trend. And actually, my timeline was really skewed because I took like 8 months to do one price rebalancing, which I think is unrealistic. I don't know why I did that, but ultimately it worked out pretty good. But what we really have here is the trend, reversal, retracement, consolidation to a trend, a reversal, a retracement, consolidation to a trend, and now we're entering a reversal. Who knows how long it's going to take, or who knows how deep this reversal is going to go. I believe we are in a reversal phase right now, and I do believe that we will see lower prices. But I mean, could be wrong. I mean, it really looks like we'll see lower prices. This type of price action here, I mean, although like the one good thing that's going for it right now is that it already did dip back into this consolidation, and maybe that's all it needed to fuel a little run up. But it is looking heavy to me, and yeah, I mean, that's all I got to say about market profiles. I'll just leave you with this. I think we're in a reversal phase right now, and how deep we could go. I think I think this is a good level. 348. Maybe lower. Maybe it won't even work out. Who knows? That's the beauty of trading, I guess. We'll see. But if that doesn't work out, if it does, whatever. Hope you got something out of the 4 market profiles. I think it's probably one of my favorite concepts in Bitcoin trading, and I hope that you study it and you find some use in it. If not, whatever. You just wasted 20 minutes of your life, and I apologize for that. But anyway, have good trading, stay Bitcoining, and have fun. Peace out.